What's happening, everybody? It's Matty here from the Crypto Wolfpack. Now, today we're talking about a story that on the surface sounds like it's all about Iran. But I don't actually think this is a story all about Iran at all. I think this is a story about something much bigger. A story about one of the biggest beliefs in cryptocurrency today. A belief that many of us have held for years. A belief that crypto is beyond the reach of governments. Because according to recent reports, the United States Treasury has announced that it has seized close to $1 billion worth of cryptocurrency linked to Iran. Now, whether you're bullish on crypto, bearish on crypto, a Bitcoin maxi, an XRP holder, or somebody who only just entered the space, this raises some very important questions. Can government actually seize crypto? How do they do it? What does it mean for decentralization? And perhaps most importantly, could it happen to ordinary investors just like me and you? So let's dive in.
I am not a financial advisor. This video is based solely on my opinion on what I'm personally doing in this market. I also want to let you know that some of the links below and in the descriptions are affiliate links, meaning I may get a commission, but it will be at no extra cost to you. Please remember that under no circumstances will I ever contact you and ask you for investments. You can confirm all of my real social media handles in the description and also at milkshakematty.com. This content is for educational and entertainment only, and I'm not a financial advisor.
The headline sounds dramatic. The US Treasury has stated that it's seized or disrupted access to nearly $1 billion worth of cryptocurrency connected to Iranian-linked activities. Now, before anybody starts panicking, this wasn't a case of government agents somehow hacking Bitcoin wallets. This wasn't some magical button where they pressed and confiscated crypto. This really is far more interesting than that. Many of these enforcement actions are linked to sanctions, anti-money laundering efforts, terrorism, financing investigations, and the monitoring of financial flows through blockchain networks. The important thing to understand is that governments today have access to tools that simply didn't exist 10 years ago. Back in the early days of Bitcoin, many people believed cryptocurrencies transactions were anonymous. Today, we know that's not really true. Most public blockchains are incredibly transparent. Every transaction is visible. Every wallet movement is recorded. Every transfer leaves a trail, and that trail can be followed. So while crypto may be decentralized, that doesn't automatically mean it's invisible. And I think that's where a lot of people still get confused. For years, we've heard people say things like Bitcoin can't be touched, crypto can't be confiscated, governments can't stop it. But are those statements actually true in 2026? Well, it's a yes and a no answer, because the blockchain itself can't simply be switched off. Nobody can delete Bitcoin. Nobody can press a button and remove XRP from existence. Nobody can wake up tomorrow and erase Ethereum. Those networks continue to function regardless of what the governments think. But owning crypto and controlling crypto are two very, very different things. And that's where this conversation becomes interesting to me. Because while governments may not be able to stop blockchain from existing, they can absolutely target the people, companies, exchanges, infrastructure, and everything that's surrounding it. And that's exactly what we've been seeing happening around the world. So let's break this down. Because when people hear the word seize, they often imagine something that isn't actually happening. There are several ways that governments can gain control over cryptocurrency. The first is through centralized exchanges. If somebody holds their crypto on an exchange and authorities obtain necessary legal powers, that exchange can freeze those assets. It doesn't matter whether it's crypto, stocks, cash, or gold certificates. If a centralized company controls the assets, the company can be instructed to freeze them. The second method is through stablecoins, and this surprises a lot of people because many stablecoins have issuers behind them, and some of those issuers have the ability to freeze wallets. Think about that for a second. If a token can be frozen, is it truly decentralized? That's a question every crypto investor should at least think about. The third method is through obtaining private keys. Now, if authorities gain access to wallets, devices, passwords, recovery phrases, or other methods of access, then control of those assets can change hands. And finally, there's blockchain analytics. Companies now specialize in tracking movements across blockchains. They build transaction maps, they identify cluster of wallets, they follow funds as they move through different networks. The technology available today is far more advanced than most people even realize. Now, this is where the debate really starts, because depending on your viewpoint, you could interpret this story in two completely different ways. Bearish interpretation is simple. Some people will say this proves crypto has failed its original mission. After all, wasn't crypto supposed to remove the power of governments? Wasn't Bitcoin born after the financial crisis and as a response to traditional banking systems? Wasn't decentralization supposed to put individuals back in control? If governments can freeze assets, seize funds, and track transactions, some people will argue that we've simply recreated the traditional financial system in digital form. And I understand that argument, and partly that's how I feel too. But there's another side to this. The bullish interpretation is actually fascinating. What if this story is evidence that crypto has become so important that governments now treat it like any other major financial assets? Just slow down and think about what I've just said. Government seize cash. Government seize gold. Government seize property. Government seize bank accounts. Now they're seizing crypto. In a strange way, that's a sign that crypto has matured. Nobody laughs at it anymore. Nobody dismisses it as internet magic money. Nobody says it's only used by nerds in basements. Governments around the world now recognize crypto as a serious financial asset class, and that matters because adoption doesn't happen when governments ignore something. Adoption happens when governments are forced to deal with it. Whether you agree with their actions or not, that's a separate discussion completely. The fact they're engaging with crypto at all tells us how significant this industry has become. Now let's talk specifically about Bitcoin, because somebody in the comments will inevitably say, yeah, but they can't seize my Bitcoin. And technically speaking, if Bitcoin is stored properly in self-custody with secure private keys, then it becomes significantly harder for anybody to gain control of it. That's one of the reasons so many people are passionate about self-custody. The phrase, not your keys, not your crypto, exists for a reason. If somebody else controls access to your assets, there is always some level of counterparty risk. But let's be realistic, because most people don't hold their crypto that way. Most people use exchanges. Most people will use some kind of a custodian. Most people prioritize convenience, and convenience often comes with a trade-off. And that's true in crypto. It's true in banking, and it's true in life genuinely. Here's the question that I think matters the most. Could this happen to ordinary investors? Now, before anybody panics, I'm not suggesting governments are about to start confiscating random people's portfolios. That's not the point of this video. The point is understanding where your risk exists. If all your crypto is held on an exchange, your experience is very different from somebody using self-custody. If you're holding stablecoins, your risk may be different from somebody holding Bitcoin. If you're using decentralized protocols, your risk may be different from somebody using centralized platforms. The lesson here isn't fear. The lesson is education. Understanding how your assets are stored is just as important as choosing which asset to buy. And yet most people spend far more time researching coins than researching custody. And that, for me, is a massive mistake. What I find fascinating is that crypto seems to be moving in two directions at exactly the same time. One side, we're having increased decentralization, that's self-custody, decentralized finance, permissionless systems, peer-to-peer transactions. And on the other side, we have increasing regulation, institutional adoption, government oversight, stablecoin legislation, and compliance regulations. And those two forces are now colliding in my eyes. The crypto industry is no longer a small underground movement. It's becoming part of the global financial system. The question is now whether it can maintain its original principles while doing so and moving forward. And honestly, I don't think anybody knows the answer yet. We don't know how this is going to pan out completely. We're watching history unfold in real time. So when you see a headline saying that US Treasury has seized close to $1 billion in cryptocurrency linked to Iran, don't just focus on that number. Focus on what it represents. And it represents a world where crypto is no longer on the outside looking in. Crypto is now part of the conversation. Governments are paying attention. Institutions are paying attention, banks are paying attention, and whether you love that or hate it, it means the industry is becoming impossible to ignore anymore. The real debate isn't whether governments can seize crypto. The real debate is where the line exists between freedom, security, privacy, and regulation. And that's a conversation that is only just beginning. Now, I'd love to hear your thoughts. Do you think this is bullish for crypto, or do you think it's bearish? Do you think government should have this level of power? Do you think this completely goes against what crypto was originally designed to achieve? Drop your thoughts in the comments below. And also, if you are looking for a self-custody solution, then please head over to tangent.com and at checkout, use the promo code Milkshake Matty to go and get yourself a discount on every single one of their wallets. Or there'll be a link in the description that you can click and the deal will be preloaded on the screen for you. If you enjoyed today's video, don't forget to hit that like button and subscribe to the channel, because we've recently passed 10,000 subscribers and the next target is 11,000. So thank you to every single one of you who's helped us get this far. And before you go, if you enjoyed discussions like this, don't forget to check out the UK Crypto Podcast, which I co-host alongside Paula Talks Crypto. We release a brand new episode every Friday at 7 p.m. UK time, and we're covering everything from Bitcoin XRP to regulation, adoption, market trends, and interviews with some fantastic guests from across the crypto industry. I'm going to put the podcast playlist somewhere up here above my head so that you can click it and jump straight into the latest episode, and I'll see you over there. Until next time, take care, and remember, the strength of the wolf is in the pack.